Good afternoon to our audience. I'm going to give it 30 more seconds and then we can start. But thank you so much for taking the time to join us today. We know that everyone has hectic and busy schedules. It's been a crazy start to the year, but we're really looking forward to talking to you today, to introducing the team, giving you a few updates on what's been happening on the Ashburton side. Cool. So thank you and good afternoon. A very special warm welcome to the clients, both of Ashburton and the broader First Rand Group. By way of introduction, my name is Sam. I've recently joined the corporate and institutional distribution team at Ashburton, working very closely with our corporate treasuries on your cash management and investment needs. We are extremely proud, and I'm extremely proud to have joined this organization. We've experienced so much growth in the past few years, and we continue to be client-centric to enable us to offer the best possible service, performance, as well as rates. So continuing with the theme of keeping our clients as informed as possible in these uncertain times, this is one of the first series of webinars, corporate webinars specifically, that we're looking to host, focus on funds which you, our corporate clients, predominantly invest in. So we're super excited for today's lineup. First up, we have Albert Botha, who is the head of our fixed income business at Ashburton, as well as a portfolio manager on a number of the fixed income funds. Albert will be giving us a short economic and market update, followed by portfolio and performance updates, specifically on the Ashburton Money Market and the Ashburton Stable Income Fund. In the second half of the session, we have our much anticipated and very exciting keynote speaker, futurist Mitch Ilbury, talking through flexible mindsets, good futures thinking, and being able to remain dynamic in today's uncertain world. You'll have a chance for Q&A for both Albert and Mitch at the end of the hour. So without any further ado, I'll hand over to Albert. Thank you, Albert.
Good afternoon, everyone. Give me a second just to load my slide deck, and I will be right with you. So they decided to put the boring fixed income markets update first, followed by the futurist at the end. So I'm going to quickly run through some of the portfolios that we look at, what their purposes are, and just a quick update, and then just spend a couple of minutes on what we are currently seeing in the markets and currently what's happening. So as Sam mentioned, that this is effectively a focus on the two specific portfolios that is widely used by our business and corporate clients. The first one being the Ashburton Money Market Fund. All the various details are there on the screen. This fund specifically, as many of you know, is there for primary short-term liquidity purposes. We've optimized this fund over the last couple of years to focus it specifically on the business environment. It's a corporate money market fund. In other words, it has no non-bank paper. All paper in there is either issued by the big South African banks or by National Treasury or by AAA rated international banks. It has a T+0 liquidity window. So if you give your withdrawal instructions early in the morning before 12, you get T+0 liquidity. It's got 3 different liquidity payment periods during the day. Sam can give you all of the various details on how that works, what the various cutoffs are. And we are consistently striving in this portfolio to make it significantly more user and client friendly, as that seems to be the primary requirement from our clients to enable it for its use there. The other fund is the Ashburton Stable Income Fund. That portfolio specifically I've been managing since 2009. And it was created to be effectively a money market beta fund. So in other words, it was structured such that it should give you between 1 to 1.2% of additional return every month. Every year relative to money market funds. It's a slightly longer fund. It's got quite a bit longer track record, and there are a couple of differences between the two portfolios. The primary two being that the maximum instrument life, it rises from 13 months to being functionally unlimited, although in practice the weighted average life of the assets in stable income is around about 2 years. The other big difference is that this fund does use corporate paper. So the fund is still very heavily invested in the big 5 South African banks and treasuries. That accounts for about 60% of the fund size. The other 40%, however, is invested in a range of South African corporates. And we don't take duration risk specifically in this portfolio. And you can see there that the yield is a little bit more than 1% more for stable income than it is for the money market fund. So just a little bit of a focus on the money market fund. I've already discussed liquidity. It does have an official rating by GCR. It's rated AA+. As a reference, we will be sending you this presentation if you are looking at, if you're looking to invest, or if you have any further questions, you can contact Sam and we can set up a conversation. This portfolio is qualifies as board notice 90, regulation 28. And has all the similar restrictions to that you're used to in a money market portfolio. From a current asset allocation perspective, one of the things we found over the last couple of years, specifically post 2020 March, effectively our initiation of COVID, is that the South African Reserve Bank paid up quite a bit more related to South African banks on treasury bills versus NCDs. So you'll see quite a heavy concentration of treasury bills issued by the South African Reserve Bank in this portfolio. To some extent, at least for the moment, this seems to have abated a bit. And we expect that the amount of money that we're going to be putting in the banks is going to be slightly larger. But we don't expect this to change meaningfully over the next couple of months. So at least for now, South African Reserve Banks will still be the highest allocation of this portfolio. This chart specifically, unfortunately, the money market performances of peers aren't available until about the 6th day of the month. So we can't show any of those numbers that are fresh yet. What we do have on the screen, however, is the outperformance of the fund as the primary institutional fund class relative to benchmark. That's the fund is in grey, the benchmark is in blue. And in orange, what we have there is we can see the effective daily outperformance of the fund relative to its benchmark. And you can see that the last couple of months specifically, we've done quite well on that average daily outperformance number. January specifically was a very good month for the fund, and we're hoping that we are quite looking quite good for February thus far as well. Ashburton stable income, as I said, sits a little bit further up the risk curve from the money market fund, and we can see here just effectively what the fund does and what it looks like. It invests primarily in floating rate paper and corporate paper. It's also got a rating of AA. It's also got a rating from GCR. The rating is AA-. And one of the other big differences is this fund specifically has a T+1 liquidity period. So if you give me an instruction today, the money should be in your account tomorrow. This fund, we can show performance numbers as we've got enough of a track record, and specifically in the numbers are out the first day of the month. We can see the Ashburton versus the primary peers from the largest asset managers, Net Group, 91, Stanlib, Coro Fund. We can see the performances of the last couple of years. You can see there over the last year, for example, the fund at 5.23. Most of the peers are a little bit below 5. You can see over an extended period of time, this fund has done very well. This fund has in its history won 2 Raging Bulls for best performance in class as well. And as I've said, I've been managing this fund since September 2009. Now, I think this chart specifically is important to understand because it gives you an idea of the difference between stable income and the money market fund. You can see there that the primary allocation of this portfolio is still to your big banks, FirstRand, Investec, Standard Bank, Nedbank, and ABSA. You have there what's called the Ashburton investment grade portfolio. That's a co-investment vehicle that we use that has about 30 names in it, so the diversification there is significant. BNP Paribas AAA rated and is rated higher than the SA government. The line that says Ashburton, there's the Ashburton Money Market Fund. And from there on, you see the some credit allocation. It's important to note here that we don't have a high allocation to any individual real names here on the corporate side, and we are very, very well diversified with quite a long tail of various credits. Okay, I have about 8 minutes left to quickly go through a macro outlook. And the focus for today is on inflation. In fact, I've just called it inflation everywhere. And on this chart, you'll see two lines, an orange line and a white line at the top. Now, the orange line at the top is South Africa's inflation rate, and the white line is the US inflation rate. And what you can see there is for the first time since 2004, South Africa's inflation rate is quite a bit higher than the US inflation rate. In fact, at the moment, we're about 1.8% higher. Also, it's important to note that US inflation hasn't really peaked yet. They're expecting a print pretty soon that's going to give them either between 7.9 and 8.2% for the next inflation print. So that number is going to go up another 30 to 50 basis points at least, which is going to mean that the inflation differential between SA and the US is going to hit effectively and is likely to hit an all-time high within the next month or so. And given some of the recent developments, there is going to be more inflation pressure globally. So let me just give an idea of how somewhat ahistoric the current inflation environment is. This on the screen is the German PPI, so German Producer Price Index. And it's currently running at 25%, which is the highest that they've ever seen. In fact, if you look at the time period since the mid-1970s, the mid-1970s being one of the previous global inflation peaks, you saw German PPI running at about 10%. So inflation is now more than twice, or German PPI is now more than twice as high as we saw in the 1970s and 1980s peak in Germany. And we know it effectively isn't done. So let's just look at three primary underlying issues. So if you look at some of these problems, they have been long-standing. We are familiar and aware of issues around the various supply chain crises and the various supply chain issues that the various countries are facing. We are familiar with the fact that the oil price is rising, as well as several other commodities. We saw massive spikes in lumber, etc. There's been worker shortages in places like the US, etc. What has, however, happened recently, specifically within Europe, but more broadly globally, is the events and the war between Russia and Ukraine. Now, that is important because as has been stated by politicians before, Russia is effectively a gas station dressed up as a country. They are a massive energy supplier to the rest of the world, with a massive focus on energy supply to Europe. And Europe in particular have been very anti-building in-country capacity for energy production. They have been shutting down many of their nuclear power stations, and they've been effectively outsourcing much of their energy production to other countries, in this case specifically Russia. So with the issues now in Eastern Europe, we can see that there has been a meaningful change in the price of several of these commodities, because there's also a meaningful allocation of wheat and corn coming out of Russia and Ukraine as a part of a global supply. So up on the screen, what you'll see here is just the year-to-date changes, not longer term, just 2-month changes on oil, wheat, and corn. And you can see oil is up 45%, wheat is up 30%, and corn is up 22% in 2 months. And none of this is in inflation prints that I've shown you already. So we are seeing massive increases in what's called supply side price pressures. The other thing that's also important to note is that these events, these geopolitical issues, also to a large degree reduce the various global central banks' capacity to enact meaningful monetary policy pressure. If there is a war going on in Europe, your central bank is less likely to be as aggressive on rates as they would have been absent a war. So where there was a lot of discussion and still a lot of issues around the potential for inflation to spike and potentially spiral out of control, there is meaningful inflation pressures going on in the rest of the world, and they are going to filter through to South Africa. That does not mean we're going to see a long-term inflationary spiral that lasts a number of years. But it is going to mean that the Fed is going to need to somewhat stretch their definition of transitory. Inflation is likely to surprise on the high side and keep on surprising on the high side for at least most of the rest of this year, barring a very quick and meaningful unwind in the Eastern European theatre that will then affect many of these prices and see them fall. So what does that mean for South Africa? Well, as of about a month ago, our baseline scenario for inflation, as you can see on the screen, is that inflation would average about 5.2% this year, go to 4.6% next year, and 4.5% the year thereafter. That's up about 20 basis points. We had about 5% inflation towards the end of last year. We had to push that up slightly. In scenario 1, which currently seems to be a relatively a potentially likely scenario, we can see that what would happen if the oil price averages $100, right? And then scenario 2 is what happens if the oil price averages $110. Now, year to date, the oil price has averaged about 90. So the oil price would have to sit at around 105 or so for most of the rest of the year. Then it will average about 100, a little bit over 100. So it seems increasingly likely that inflation is going to peak, that yellow line above the band, in the next couple of months, and that we can see an average inflation of 6% for the year, followed by 5.2 and 4.8. Thus far, we don't think the scenario 2, 110 average oil price is likely, but I've added it on the screen there just for interest's sake. So as a last point, what does that mean for rates? Both of these portfolios, both stable income and money market, are extremely sensitive to the repo rates in the country. Within about a 2 to 3 month period post a repo rate hike, the funds reflect most of that repo rate hike. Looking at the forward rate curve, what's called the FRA curve for forward rate agreements, the market currently has about 1.6% in hikes over the next 12 months and 2.4% in hikes over the next 24 months. Now, 1.6% of hikes effectively means if a hike is 25 basis points, that means it's 6.5 hikes in a 12-month period, which is more than one hike a meeting. So from a practical point of view, regardless of how bad inflation seems to be at the moment, the curve seems to be overestimating the capacity of the SARB to hike, specifically given the various GDP growth issues in our country. Having said that, we are expecting at least another 3 hikes for this year. So it's, in our opinion, likely that we will see between 75 to 100 basis points, or 0.75 to 1% worth of hikes over the next 12 months. But there is the caveat that we need to cautiously watch things like specifically the various commodity inputs and oil to see where they keep on rising. And if oil keeps on going up and we start seeing $110, $120, $140 oil, we're going to have to reassess those views. For now, troublesome, sticky, but still eventually declining inflation and about 1% worth of rate hikes over the next 12 months is our base case for most of these portfolios. And both of these funds will see the effect of repo rates in the forward rates and expectations. I will be around for any questions that you may have towards the end of the session. I hope you enjoy the much more exciting futurist relative to the fixed income PM. Please stick around for questions and let us know if there's anything else we can help with. Thank you.
Thank you very much, Albert. It's very scary times that we're living through, and remaining on the theme of client centricity, it's really good to know that the funds and build that trust up with our corporate treasuries, our CFOs, our treasurers, to ensure that the money they do place with asset managers are being managed in the most stringent and capable hands through these challenging times. So thank you, Albert. As Albert mentioned, we are now super excited to introduce our keynote speaker, Mitch. I'm just going to do a short intro on Mitch. Mitch is the director of scenario planning for MinderFox, and he's the founder of the education and technology company Growing Foxes, which helps schools and other institutions teach futures thinking. He holds an honors degree in philosophy from the University of Cape Town and a master's degree in intelligence and international security from King's College in London. Mitch recently published a book with Clem Santa titled Thinking the Future, New Perspectives from the Shoulders of Giants. He has facilitated strategy sessions in Africa, the UK, and Australia. So that's a very, very, very long list of achievements, Mitch. And we're really excited. Thank you for being here today. Over to you.
Thanks very much, Samira, and hello to everyone. I'm very excited to be chatting to you today. I mean, when Ashburton asked me to be a part of this, the world was very uncertain, and then over the last week or two, it's become increasingly uncertain with the crisis with Russia and Ukraine. So that puts a real premium on how we think about the future. Just like anything in life, thinking the future can either be done well or it can be done poorly. And the processes behind how we think about the future is critically important to the decisions that we make today. And especially in your field, in the world of finance, in the world of making financial decisions, your decisions have massive consequences for your businesses and for the people involved in those businesses. And so how you think the future, therefore how you make good decisions, is critically important to the discussion today. Hopefully you'll come away with a few thoughts on how to think the future a little bit more effectively. So the starting place for thinking about the future is actually our current context. And that's because how we make sense of the world informs how we think it will play out. Our understanding of our current context informs how we project it to potentially play out. And it should be that way. We need to ground ourselves in the current reality before we can start looking to the future. And in order to really understand this concept, I want to look back to some of philosophy's greatest thinkers. And let me start with this fantastic painting by Raphael. This painting is really a Where's Wally of ancient Greek philosophers. In the front, you'll see Heraclitus. On the front left-hand side, you'll see Archimedes. In the back left, you'll see Alexander the Great. And really, I want to draw your attention to the two central figures right in the middle, the only ones with the beautiful blue sky behind them. These two characters are Plato and Aristotle. Plato on the right-hand side with the orange tunic is pointing up to the sky. And that's because this painting is trying to represent his theory of the forms. It's symbolizing what Plato believed, which was that everything in reality is a copy of an ideal form, an ideal blueprint. And he interpreted the world that way. He used that one big theory of the world to understand the world around him, and the various disciples from his school. Next to him, to his left-hand side, or on the right-hand side of the painting as you're looking at, is Aristotle. And the secret lies in his hand. His hand is pointing down towards the earth, contrasting with Plato, pointing up towards the sky. And that's because he thought that rather than trying to understand the world through this theory of the forms, through one big idea, rather we must take our cue from reality. He was really the father of what we consider modern day science. He said that we need to take our cue from reality and piece the different pieces of the puzzle together to try and represent reality as best we can. And so this painting tries to mark a fundamental distinction between two different ways of engaging with the world. One, engaging with it through a big central idea and then using the evidence to understand and justify that theory, versus the other one, which says, well, we don't have that theory. We don't have some big overarching theory that unites our understanding of the world. Rather, we need to engage with the different pieces before us and try and build a rational understanding of that. And Raphael captured this masterfully in these two hand gestures between Plato and Aristotle. A more modern day way in which we can interpret this distinction, and it's critically important that we do, is to think of how we engage with puzzles. If you think of all the different pieces of a puzzle, you've got to try and put them together to try and create a coherent picture. Now, often when you buy a puzzle, the picture that you're trying to create is on the puzzle box cover. And that's what Plato would have said. He would have said, well, you know, we have this cover, we have this cover for life, and we need to piece each piece of the puzzle together in accordance to that understanding, in accordance to that theory, in accordance to that picture of the world. Whereas Aristotle would have said, well, hold on, Plato, we don't actually have access to a puzzle box cover in life. We don't know how things should fit together according to one overarching central theory. Rather, we're just given this array of puzzle pieces and we need to make our way in the world with that. So you might think about how rationally you would engage with the different pieces. You might start by putting the edge pieces on the outside and then grouping certain colors together, using rational principles to try and piece together what inevitably would be a more coherent picture of the world. And so understanding this fundamental distinction between different ways in which we engage with the world is critically important to how we then think it's going to play out and how we engage with the future. So what does it mean to think the future, and what does thinking the future have to do with these ancient Greek philosophers? Well, I'm going to refer to another beautiful painting. This is by Albert Botha, and he was part of the Italian futurist school of artists that were, really prominent at the turn of the last century. This was done in 1913, and believe it or not, is actually depicting a cyclist. The name of the painting is The Dynamism of a Cyclist. And what the Italian futurists tried to do is capture the energy and dynamism and power of this industrial world, this modern world that we were entering into at the time, in that lead up to the First World War. And they were trying to capture that motion in this painting. And really, I think it's a great background to talk about how we engage with the future and how we think it's going to play out. Every decision that we make relates to the future in some way. Therefore, how we engage with the future, how we think it's going to play out, affects every decision we make today. And that's why it's a critically important dimension to understand and to do more effectively, such that we can make better decisions today. So what does it mean to think the future? Well, one answer you might give is surely it's about accuracy. It's about having an understanding or imagining how the world may play out, and then having that be an accurate portrayal of how it eventually turns out, i.e. thinking about the future is all about accuracy. And no doubt that's critically important. If it wasn't, then every thought about the future would be relativistic. Any thought of how it may play out would be the same as any other expectation. And obviously that can't be the case. Accuracy is a part of the answer about how we think the future. It's very important. But what I want to highlight today is that accuracy is not the whole answer. Thinking the future goes far beyond accuracy. And that's because accuracy, or thinking the future is all about accuracy, leads to three fundamental problems. One, we tend to home in on more precise estimates. That's because we're trying to be as accurate as possible. So if you think about the forecast we make of the future, the more accurate and poignant we make them, then the more we can kind of hold our hands up to say, yes, we got it right, because we were so accurately predicting this one scenario. So thinking it's all about accuracy makes us home in on more precise estimates than the uncertainty of the world should allow for us. Second problem associated with accuracy is that we tend to bet big on a single answer. Because we want to try and be accurate in our predictions, we bet big on this one answer and then again laud ourselves when we get it right. But more often than not, we're going to get it wrong, because betting big on a single answer again fundamentally misunderstands the uncertainty and complexity of our world, which really requires a more nuanced understanding of reality, understanding that reality may play out in a varied or myriad different ways. Finally, one of the major problems about thinking about the future through the perspective of it being about accuracy is that it puts all the emphasis on the outcome of a prediction rather than the process underpinning it. So if you think about forecasts, all the headlines come about to say, right, this is the prediction that so-and-so made, or this is the prediction or the forecast that this company made. It puts all the emphasis on the outcome of that prediction. But what's really important about thinking the future is that process that underpins it, understanding the method to the madness of trying to think about the future more effectively. I want to highlight one very poignant example of this forecasting or this reliance on accuracy going incredibly wrong. And I think it's very important so that I can put my money where my mouth is to say that forecasting the future is really a fool's game. This was the growth projection from the IMF in April 2019. And as you'll see here, the projection for 2020 of the global economy was that we were going to grow at 3.6%. In advanced economies, we're going to grow at 1.7%, and in emerging markets, going to grow at 4.8%. So this was the economic outlook. This was the forecast for the world in 2019. Now, of course, we know what happened. In reality, this was an updated forecast by the same organization, the IMF, in June of 2020. Here you'll see the projection for 2020, or the rest of the year, for the global economy was minus 4.9%. For advanced economies, it was minus 8%, almost a 12% differential. Then emerging markets, minus 3%. So this highlights the massive disparity between the expected outcome of their forecast and what turned out in reality. Now, you might come back and say, okay, this was a crisis like no other. We experienced a global pandemic, the likes of which we haven't seen since the Spanish flu. But that's exactly the point. Forecasts tend to miss these big strategy invalidating tipping points. They tend to miss those extreme events that fundamentally reshape our world. And that's because they take data from the past and then extrapolate it into the future. And so it tends to create the single line projection, misunderstanding this complexity and uncertainty of our world. And so it lulls us into the sense of expectation of how the world's going to play out. And in fact, can turn out very differently according to crises such as the global COVID-19 pandemic. Herman Bale and Michael Levitt were two great academics that really looked into the process of forecasting. And they said, for many planning purposes, knowing what is likely to happen is of some interest, but of greater import is knowing what low probability but high cost or high benefit situations might be possible. Models that are developed to fit the former criteria will be hard pressed to perform the latter. So these models of forecasting the future may be of some utility in estimating things playing out with some level of consistency, but they fail in modeling those extreme events that fundamentally reshape our world, those black swan moments that change the game. So what does thinking in the future require? So in the book that Clem Sumter and I published with the Penguin at the end of last year, we highlight in a very simple way that the essence of thinking the future is to understand the patterns of forces propelling the president to the future, and to see where those forces can lead, not where they will lead, but where they can lead. Then posing the right questions to anticipate change. Understanding how we engage with the world in the current context, seeing the patterns at play, and then playing out those scenarios to see where those forces can lead, and not being so foolhardy to think we know where they will lead, and then asking the right questions all the time to underpin those assumptions and to say, are we getting this right or are we getting this wrong? And having that humility in our expectation for the future. One of the great giants that Clem and I mentioned in the book was Isaiah Berlin. He was a philosopher based out of Oxford in the 1950s. And he unearthed a fragment from the ancient Greek poet Archilochus, who says, the fox knows many things and the hedgehog one big thing. And he used this fundamental distinction between how we engage with the world to look at some of history's greatest thinkers and to see some of them, how they hinged all of their thinking around one big theory, such as someone like Karl Marx, versus foxes who were much more agile and dynamic in their thinking, understanding the complexity and contradictions in our world and being more comfortable in those contradictions. Now, one of the great books of our time that many of you will probably have stuffed in your library, perhaps wedged between your copy of Rich Dad, Poor Dad and Who Moved My Cheese, was the book from Jim Collins called Good to Great. And this was a #1 bestseller and sold millions of copies around the world. And in that book, he highlights the importance and value of hedgehog thinking for leadership. But we think that he got that fundamentally wrong. In our book, Thinking the Future, we highlight the importance of thinking like a fox. And that's because in today's very dynamic and uncertain world, this expectation of thinking of the world according to one theory, such as how a hedgehog does, means that you have blinkers on. You are unable to see the complexity and uncertainty around you and unable to see what's happening on the periphery and how that might reshape your understanding of the business world. And so we have this fundamental distinction that I want to play through the rest of my talk today. These are a few examples of great sports people and musicians: Tiger Woods, Serena Williams, Yo-Yo Ma. And it's a fetish of marketing agencies around the world to try and laud this fact that if we go after something with an absolute relentless passion, no matter what, ignoring all of the other alternatives, we can go on to achieve outstanding success, such as these three people have. But these people are exceptions to the norm. Not everyone can be a Tiger Woods or Serena Williams or Yo-Yo Ma. Rather, the rest of us need to understand how the world is going to throw us curveballs. How we engage with that, how we be agile enough in our thinking to anticipate that change is critically important. Not every one of us can have one big idea and go after it no matter what, achieving this amazing success. To put it slightly more eloquently from Mike Tyson, everyone has a plan until they get punched in the mouth. You have this expectation for how your future is going to play out until you hit the reality of life, and it fundamentally changes your view of reality and how you think things are going to play out. How then do you have the agility and adaptability to be flexible enough to adapt to that change? Forecasting the future is a fool's game, and I'm going to explain a little bit about why that is. Philip Tetlock, who's a great academic based out of the University of Pennsylvania, looked at forecasting and looked at expert political judgment and asked the question, how good is it? And he did a very robust study that studied over 82,000 forecasts made by so-called experts for more than 2 decades. He picked 284 people that made their living commenting or offering advice on political and economic trends. The people that you see reeled out on news-based panel shows, giving their expert predictions on what's going to happen with Ukraine and Russia, what's going to happen with China and Taiwan, what's going to happen with North Korea and nuclear war. So how good is it after studying these 82,000 forecasts? Well, the punchline is that they're as accurate as dart-throwing chimpanzees. In other words, completely random in their predictions. In fact, the accuracy of an expert's predictions has an inverse relationship to his or her self-confidence, renown, and beyond a certain point, depth of knowledge. That means the more famous they are for their predictions, the more they're considered experts, the less accurate they are in terms of their predictions. And that's because these thinkers, these experts, tend to get in a groove of understanding how the world works and then expect it to play out as it has done in the past, according to their vision of their expert analysis, rather than understanding how complex and uncertain our world is and anticipating how the future may be different from the past. In this analysis that Philip Tetlock did, he used the distinction between foxes and hedgehogs and said that foxes make better forecasters. And that's because they embody these different abilities and thinking styles and outlooks. And I want you to ask yourself today, how many of these attributes do I embody? How many of these attributes does my team embody and the people, my colleagues that work around me? So Philip Tetlock says that the better forecasters, the foxy forecasters, are cautious. They understand that nothing is certain. They're humble. They understand that reality is infinitely complex and non-deterministic. In terms of their abilities and thinking styles, he says that they're more open-minded. They're intelligent and knowledgeable with a need for cognition. They're intellectually curious. They're reflective and self-critical, and they're numerate. They're comfortable with numbers. In terms of their methods of forecasting, they're pragmatic. They're not wedded to any one idea or agenda. They're analytical. They're dragonfly-eyed, which means they value diverse opinions. They're probabilistic, means they judge using many grades of maybe rather than things as black and white. And they're thoughtful updaters. When the facts change, they change their minds. And then finally, good intuitive psychologists, aware of the value of checking thinking for cognitive and emotional biases, checking ourselves, questioning those assumptions. So this is what makes a foxy forecaster. But what Clem and I say in the Thinking the Future book is that while Philip Tetlock highlights the value of foxy thinking, he gets one thing fundamentally wrong, and that's foxes don't forecast. They're too smart for that. They understand that this process of forecasting the future is a fool's game, and rather they do something slightly different. Now, Pierre Wack, who was a great scenario planner for Royal Dutch Shell in the 1970s, pointed to the process of forecasting like shining a torch in a dark room. You get the slither of light that shows you or might give you some insight as to what's there, but nothing else around that. Now, really, it's about forecasting the future in today's complex and uncertain world is really like shining a torch in the dark room where everyone inside is playing musical chairs. Every time you think you've got some view of reality or how the future is going to play out, the music starts, people move in their chairs. The next time you shine the torch, it shows a completely different picture, as you might have done before COVID-19 pandemic, or as you might have done before this Russian crisis. It changes the view of reality. And so every forecast that you make shows just one snapshot of reality, and that will fundamentally change from day to day because of the complex nature of our world. So how do foxes engage with the future? Well, foxes imagine scenarios. These are plausible stories for how the future may play out. Instead of wedding their perspective to the future on a single forecast, rather they understand that it may play out in different ways and look at the future according to different scenarios to then use that analysis to help their decision making today. Now, I've used this example, another great painting, considered one of the best of modern art, from Andy Warhol, called The Maryland Diptych. Now, what's interesting about this painting is that there are actually two paintings that have been put together. So Andy Warhol did the first one on the left-hand side of Marilyn Monroe when she was still alive, highlighting the glamour and sexiness of her and in her industry and the fame surrounding her. And then the second one, after she had an overdose and passed away, highlighting the tension, anxiety, and depression that she had in her private life. And it wasn't until two art buyers came into Andy Warhol's house and said, well, hold on, those are two brilliant paintings, but really they need to be put together to show this difference between the public life and the private life of Marilyn Monroe. Andy Warhol considered it a work of brilliance of these two art buyers and put it together, and then said, well, you know, it's so obvious now that he's seen it that they have to be together to show this contrast. And it highlights the importance of scenarios, of understanding that there may be two ways of seeing the same thing. Moreover, why this is a very relevant painting for scenarios is that the history of scenarios has its foundation in Hollywood. Herman Kahn, who was considered the father of scenario thinking, actually came up with the concept after engaging with Hollywood producers who would put together little scenarios, little scripts, short scripts of their overall movie that they wanted made, and would take that to the publishing houses to try and see if they can get this movie commissioned. And there were little scenarios, little stories that captured the essence, the narrative of what that movie was about. And Herman Kahn thought this was a brilliant idea to try and capture some essence or narrative around how the future may play out. And he wrote a great book on thermonuclear war, where he spoke about this concept that actually was then the feature of the Stanley Kubrick film and the Doomsday Machine that you should all be familiar with. And so scenario planning is a fundamentally different approach to thinking about the future than forecasting. It says, instead of us betting on one single projection of the future, let's anticipate it playing out in different ways and use that to inform how we engage with the world. So let me practically apply some of these scenarios to the world at the moment so that you can see how it's done in action. So there are an infinite number of uncertainties we can engage with, but really if we can boil it down to two to try and provide some clarity, is that the future of our world largely depends on two axes, and one being how united we are and how countries engage with one another, and we put that on a vertical axis, and then how the economy, global economy grows, whether we're experiencing global growth or whether we are experiencing a global recession. Now, if you combine these two key uncertainties, it yields four very different contrasting scenarios for how the future may play out. In the top right-hand corner, we call the new balls please. This is where new technologies spearhead a green revolution and countries unite to address global challenges, especially around things like climate change. This is a best case scenario that we hopefully would work towards. On the top left-hand side, where we have one world but a global recession, there are no serious outbreaks of war and violence, but nations rally together to endure a stalling global economy. So things are tough economically, but at least the countries around the world are somewhat unified in their view of the future. Contrasting to that, where we have global growth, but that happening in a very divided world, we have what we term a UV scenario, a two-speed scenario, one where some countries experience slow economic growth, where others come out of the COVID-19 pandemic with some vigor. And others struggle to ignite economic growth, especially as vaccine inequality deepens. The UV typically would refer to our economic growth, but in today's world, it could also be about the vaccinated and the unvaccinated and the potential consequences of that for the relevant economies. And this is very much where we saw ourselves at the end of 2021. And then finally, in the bottom left scenario, the fork lightning, we all get hit by another global crisis that strikes a new spiraling trajectory of economic decline and rising tensions. And the Russia-Ukraine crisis is very much a flag for this scenario. It's very much indicating how globally we're heading to a more divided world. And because of these economic sanctions and the importance that Albert mentioned around Russia from an energy perspective, it puts a global recession back on the map, especially if we start adding the inflationary pressures. And so that fork lightning scenario has quite a high probability of playing out. And so you need to have all of these different scenarios in your mind, not have a bias for one or the other, but rather look at the evidence, like Aristotle would have said, and try and piece together a rational understanding of how you think the future will play out, all the while understanding that things may change and take us to a different scenario. And that's a much more agile way of thinking rather than relying on a single forecast for the future. Now, I've got a few minutes left, and I want to just leave you with a few principles for good futures thinking that you can take forward in your life and in your professional careers. The first of which, I'm going to come back to that painting that I started with at the School of Athens. On the left-hand side, you'll see here, dressed in the green tunic, is the character of Socrates. He has his fingers held out as if he's saying, all right, if you think this, then you're concluding that, and showing the people around him the error in his ways, as he was so often pointed to in ancient Athens. He was actually considered a gadfly because he was so annoying in his pursuit of trying to understand people's arguments for the nature of reality. But one of the legacies of his philosophy is that we have to always question our assumptions. And this is a critically important facet of thinking about the future, because otherwise we get carried away with our expectations for how the future may play out. And we don't question those underlying assumptions on which we build this edifice of knowledge or this edifice of expectation. So really, thinking about the future more effectively requires us to question the assumptions that we build these expectations on. Embrace that Socratic process of saying to a colleague of yours, okay, if you think this is how the future of the Ukraine crisis is going to play out, what about X? Or what about Y? Get them to engage with that. That process will make your thinking about the future more robust and more holistic in its understanding. I want to go to another philosopher, a philosopher by the name of David Hume, who was around in the Scottish Enlightenment. And he was famous for a saying where he said that reason is the slave of passion. He said that we need to understand that while we are rational creatures, we are also emotional, passionate creatures. And those emotions, those passions we have provide our motivations for things. It's like driving a car, and sometimes we have emotions steering the steering wheel, and rationality is on the back seat. But what we need to try and do in our decision-making process is put rationality back in the front seat, steering the steering wheel, and use our emotions, our passions for life to be the engine that pushes us forward, but all the while having our rationality steering the car. So we need to understand that reason is the slave of passion. And as we engage with the future, and as we engage with the different facets that make up the future, we need to constantly be aware of the potential for our biases to come in around our passion and our emotion. If we get angry or frustrated about what's happening in Ukraine or in Russia, and we have that inflict our decision-making, that's poor futures thinking. We rather need to be more objective and understand the different forces at play in a more rational way. Finally, I want to come back to another school of ancient Greek philosophy, and this is Stoics, the Stoicism. And they actually got their name because they used to practice their philosophy on the Stoa Poikile in the agora of ancient Athens, where they would walk up and down this porch, Stoa means porch, and practice their philosophy. And the fundamental distinction in their philosophy was that we need to understand what is within our control and what is beyond our control. And this is a critically important facet for thinking the future, understanding that so much of what we engage with in our lives, in our professional capacity and in our personal lives, is beyond our control. We cannot shape it one way or another. Now, that doesn't mean that we need to completely ignore it, but we need to understand that we always need to come back to those dimensions that are within our control. That is what we can make decisions about. Sure, it needs to be about how we engage with the world, but we can't get emotionally angry or frustrated at things that are happening, maybe from the ANC perspective or things that are shaping South Africa, and say, oh, these are so frustrating, they're so annoying, and get emotionally invested in that. Rather, we need to say, okay, that is reality. That is the game that we're in. That is the environment that we're operating in as a business. How then do we make decisions within our control to shape our understanding going forward? So finally, I just want to leave you with a summary, just to highlight some of the points that I've made today, such that it makes coherent sense for you. So I started off by saying how we make sense of the world informs how we think it will play out. We need to start from a good contextual understanding of our current reality. Then the essence of thinking the future is to understand the patterns of forces propelling the present into the future. It's about understanding those patterns and then seeing where they can lead, not necessarily where they will lead, and then asking the right questions to anticipate change. This process is best emulated through imagining different possible scenarios. Scenario planning is how it ought to be when you're engaging with the future. And really, the foxes do this best. So you need to think like a fox. You need to entertain multiple perspectives and constantly update your beliefs in the face of new evidence. What are some of the core principles for thinking the future? One, embrace that Socratic principle of questioning your assumptions. Don't build your edifice of knowledge on these flawed foundations. Rather, really get to grips, making sure that your foundations are solid, built on solid facts, and then building your understanding of reality and the future from there. David Hume, understand when reason is the slave of passion, and always come back to those rational principles and objective fact when making your decisions. And then finally, the Stoics highlighting that we need to always distinguish what is within our control versus what is outside of our control. And rather than get emotionally involved in the external environment, rather come back to what is within our control from a strategic perspective that we can make decisions about. So hopefully this provides you with an outline of how you can think the future more effectively. And you're welcome to go and grab Clem and my book, and it takes a number of these concepts and puts it into more detail. But really, it's about that active process of imagining different scenarios, thinking like a fox, and engaging with the world, understanding what is beyond your control and what is within your control. So I'm going to leave it there and open up if there are any questions that you may have for me.
Thank you very much, Mitch. That was extremely insightful. I think sometimes, when we get so busy with our day-to-day lives, we, forget to actually realize, we forget that, we need to plan for different types of scenarios and look further than the tunnel vision, which we were taught and we grew up with, and, in organizations as well. It's, the dynamic way of thinking, I think needs to change, and it is changing, especially in this digital world. We just have 2 minutes for 2 quick questions, maybe one for you, Mitch, and one for Albert. Shall we go with Mitch while we're on that topic? Mitch, we have a question. It seems like the frequency of black swan events is increasing. The tails of the distribution curve are fattening. Do you agree with this? And do you have any insights into why this could be the case?
Yes, I think because we live in a much more interconnected world. So if you think of the butterfly effect, there's greater potential for one instance on the other end of the world to shape our current reality. I mean, we're seeing that with Ukraine and Russia. It's something that's happening very far from South Africa, but it's going to have massive consequences for us because we exist within this global economy. And so I think that's why we have this perception that black swan events seem to be increasing, like the COVID-19 pandemic, like various other instances of climate change events. And that's because we're just much more connected as a human world. And so something that's happening in one area has this butterfly effect. And that's why I think it's ever more important for us to entertain scenarios. Now, of course, we're never going to imagine all of these black swan events, but it's critically important to have a perspective that you're always on the ready for them. I think that's the point. Scenarios are not about predicting what's right. It's not because you're imagining the future playing out in different ways, therefore you're going to capture these black swan events, but rather it's going to bring back to your strategic thinking ability that agility, such that when something does happen out of the blue, you're much more prepared for it and adaptable in your thinking. So I think that's where the emphasis needs to be, not on the prediction, but on how you position yourself in relation to it.
Great, thanks. Thank you, Mitch. Albert, maybe just a quick one for you. In terms of liquidity, for our corporate treasurers and our corporates, liquidity is quite important in these funds. So how do you manage it, on the basis of if a client comes into the market and they want their cash on the same day or the next day, how would you position the fund so that you are able to give them access to that liquidity?
Okay, so thanks, Sam. So I think one of the first things we do is the liquidity management process starts at initiation. In other words, we limit clients to be a less meaningful part of any one portfolio, such that we don't find ourselves in a position where a client is 15-20% of the fund, and hence if they need their money, we might struggle with liquidity. So we limit our clients to 10% or less of the portfolio at initiation. And then furthermore, specifically in all of these portfolios, we tend to look and ensure that all the assets that we buy, or at least as many of the assets as we think is appropriate, remains highly liquid. And we've had quite a few liquidity calls over the last couple of years, as you might imagine. About 3 weeks ago, we had to withdraw about 2.5 billion rand on one day for one client from the 2 portfolios. So we have seen some meaningful liquidity events and managed meaningful liquidity across all the portfolios. So it is something that we focus on a lot. It's probably one of our primary focuses in these funds, along with ensuring the returns are there.
Great, thank you very much, Albert. So we are out of time. But if you do want more information on these two funds which we talked about, the money market and the stable income fund, the returns are looking great with the rate hike which we saw recently. Please reach out to me and we will give you more detail on that. Thank you again for tuning in, taking the time. We really appreciate it. Enjoy the rest of the week. Cheers everyone. Bye bye.